this part, you're going to learn the basic fundamentals of trading. You're going to understand risk and how to calculate the risk-reward profile. We're going to talk about trading ETFs. You're going to learn some different sector ETFs. Also, you're going to learn how to think like a successful trader and really build and cultivate that trader mindset that's going to be conducive for long-term success. And then we're going to finish off this part with talking about debits and credits, the mathematical core of trading options. And then I'm going to give you an introduction to futures. It's important to trade with the trend. As the adage goes, the trend is your friend. Why swim upstream or fight an uphill battle when you can flow with the market and ride the trends and make your trading that much easier? Trade fundamentally strong companies. If you're going to be buying stocks, buy stocks that pay dividends. If you're going to own shares in your retirement account, or if you're going to buy stocks in general, why not collect those quarterly dividends? Go long shares in bull markets, and then on the flip side, you sell short shares in bear markets. Always buy shares with a limit order. That's a good truth to hold forward. There's no reason to be paying market prices, which is why you always use limit orders when you're trading stocks, options, spreads, or anything. Have an exit strategy for each trade you make. Have a plan and stick to it for every trade that you make. Some more basic fundamentals of trading include earnings per share, also known as EPS, the profit margin, PE ratio, earnings growth, the PEG ratio, the price to book current ratio, return on assets, the beta. The beta measures the volatility, and then total cash per share. Once you go to Yahoo, you click on the finance tab, and the finance tab is going to pull up all your financial market data. If you click on key statistics under company, that'll give you a lot of these fundamental details that you just learned about. Professional traders and investors only risk 1 to 2% of their total account value or equity on a single trade. If you have a $10,000 account and the most you can lose from a portfolio risk standpoint is 1 to 2%, say 1 to 2% of 10,000 is roughly $100 to $200. So that means you'd have to be trading around a $400 or $500 trade, so that if you had a 40% loss on the trade, it would not affect your total account equity more than that 1 or 2%. If you're ever looking to make significantly more than 100% return on a trade, then you're more likely going to have to risk more than a 50% stop loss, and in this case you want to buy fewer contracts. A common risk reward is you risking $2 to make $1, or 2-for-1 risk reward. Now, to calculate the possible reward, you first want to look at the stock, then figure what the option will do on a relative basis. ETFs, also known as exchange traded funds, they're investment funds that trade just like stocks. And ETFs, or index tracking stocks, offer great diversification. Now you have that buffer, and you have a basket of stocks to where you have some insulation if you had any underlying risk on one certain security. You're not going to have that catastrophic event like you could when you're trading just in a stock, for example. Very liquid. It's a lot of volume in these products. The option chains are great, as you're soon going to see, and understanding some of the ones that you can start following and trading is important. You can trade ETFs that are leveraged. Now I want to show you a few visual representations of these different ETFs, and the first one I have pulled up here is the EEM, which is the iShares Emerging Markets ETF. The main thing you want to understand is what specific industry or indice or sector is this ETF involved with. There's 5 principles that make up that successful trader mindset, and the first one is that it's absolutely critical to always predefine and accept your risk on every trade. Cultivate an unemotional mindset that is not affected by the market's behavior. Being unemotional is absolutely critical when you're trading, and to have that successful trading mindset, because the market's going to move in all different ways, and if you get dictated by the market's behavior and you think something's going to happen and you deviate from your plan, then you're going to be doing yourself a disservice, and you're going to be diminishing your success trader mindset that you've been building upon as you move forward. Part of having an unemotional mindset is not trading too large. If you stick in a good range of your portfolio risk and your trade risk, which we talked about, then you're going to be able to have that strong mindset, and you're going to be able to navigate very effectively through any market condition. Build that self-trust that's necessary to operate effectively in an infinite environment, no matter what's going on. Really want to learn to flawlessly execute a specialized trading system that's tailored to your style. What that means is there's so many different ways to trade out there, and a lot of people are very good at a certain strategy, but that does not matter. What matters is what fits you best. Train your mind to think in terms of probabilities. And debits and credits, these are the mathematical core of options. Buying a call option or buying a put option, that's a debit trade. Buying shares of stock is a debit transaction. On the flip side, what is a credit? A credit is something that puts money in your pocket, like selling a call or a put. Futures, they're the driving force behind the stock market and the indices. A perfect example is is if the Dow futures are down 100 points Monday morning before the new market opens that week, that means that the Dow is going to open 100 points lower. So they give you a great insight and really foreshadow of what future prices are going to do. And it's important that you understand that you can also use futures to hedge your portfolio if you don't want to close out all your positions, beta weight your portfolio. And we'll talk about that later, but you can use these to hedge, and also you can day trade or just trade futures if you want to make money in them.